I want to turn from there to something which is an explainer, and we're going to try and do more and more of those on the show. Today's explainer is on the long-term capital gains tax. Remember, it was pushed up by 10% to 12% yesterday. There's no indexation for any class of assets now, including property. Only those properties bought before 2001 now get indexation. Short-term gains tax increased from 15% to 20%, and long-term gains to be taxed at 12.5%. A 24-month holding period for gold, debentures, bonds, unlisted shares. 12-month holding period for listed securities and bonds. LTCG up to 1.25 lakh tax-free, up from 1 lakh earlier. Changes come into effect from July 23rd this year. I'm now joined by Hemant Mehta, Partner Business Transformation Leader at Deloitte India. Hemant, you've got for us, and I'm going to put the various possibilities that you have, particularly when it comes to property and what impact the LTCG changes have had. Can you explain to our audiences how will this budget now affect property sales?
Sure. So before we talk on some of the cases, live cases, which probably you're going to share, there are two sides of the coin, Raj.
There we've unfortunately just at the wrong minute lost Hemant. We'll try and find out, but as you can see, Hemant and his team have devised various scenarios for us of how the long-term capital gains tax operates. And a lot of this depends, therefore, on when you purchased it, what was your purchase price. But Hemant, if you can quickly explain the graphic that we have put on the screen.
Sure. So if you see scenario one, let's look at a year of purchase, which is financial year 08. And if my sale price is 1,000, now why I put 1,000 and the next example is 400 is because the numbers actually makes the difference. If it is 1,000 was the sales price and 100 was cost, if you see in the new scenario, my capital gains is 900, 12.5% is 112.5 tax against 143.7, which was in the earlier scenario. Mm-hmm. But if you move to the next one, the example of next one, if my sales consideration are 400 and my cost is 100, now this is more likely scenario because those days are gone when you get 10 times return in like 8 times, 8 years. Nowadays you get about an IRR of 7 to 10%. If you see my earlier scenario, my index cost was 281. So my tax outlay was only 23.7.
Right. Come back to scenario 2. Yeah, please show scenario 2.
Go to scenario 2.
Yeah.
If you go to scenario, in the earlier scenario, my tax outlay was only 23.7. Now in the current scenario, when I don't get an index cost, my capital gains goes up to 300 at 12.5%. I will actually pay 37.5 as tax. Now this is where the dichotomy is. The dichotomy is not on the rate of tax. Rate of tax, we think it is very nice. 12.5% is lower than 20%, but it is fact specific. I'll give you another example. Let's stay on scenario 2. Mm-hmm. Rajdeep, I think the historically Indians basically invest in real estate because they want to do family succession. They've got 2 kids, 3 kids. People sell the flat. They buy 2 or 3 flats later, or people retire and create a liquidity scenario. So what happens is there is a section 54 which is embedded in the Income Tax Act, which says you sell one residential unit, buy another one, you get a set off. But you have to invest the amount of capital gains. Now look at this scenario which is in front of the screen. In my earlier scenario, I had to only invest 119 rupees. So 400 minus 120, 280 rupees, I could have created a liquidity and still not pay this 23.7 tax. While in current scenario, I have to invest 300 for a new flat and I only get a liquidity of 100. This is a big issue. And I think 90% Indians basically have a real estate to create either a liquidity issue, to have maybe buy 2 flats from one, or create their succession plan.
And
or
this
retirement
is
plan.
Primarily because you're saying the non-indexation has crept in.
Exactly.
Am I correct?
Exactly. This is more connected to residential immovable properties, residential units.
So in an ideal world, would you have preferred indexation? Bring it down if necessary from 20 to 12.5.
Correct.
But allow for indexation. Am I correct?
That's true. I think what we should have retained is that indexation should be given for only residential units, because that's where the real issue comes up. not for commercial. If you see the deals which we have seen in the market, in commercial market from last 10 years, people don't buy and sell commercial units. They buy and sell companies, the shares of the company holding a commercial unit, which has got an exemption now. If it's listed, you pay 12.5% or 12 months long term. If it is unlisted, 24 months long term. But tax rate is same.
What about
here? It's a real hit.
One final point, Hemal. What about inheritance? I inherit a property. How does that work?
Let's go to scenario 3. So if you see scenario 3, let's say somebody has purchased a residential flat in 1975 at 100. As per the Income Tax Act, the cost can be revised to fair market value as on 1st April 2001, which is 1,000, let's presume. And we sell at 5,000. Now, even if I don't get indexation, in my earlier situation, the 1,000 cost was indexed at 3630, and my capital gains outlay was only 274 rupees. Vis-a-vis, because I don't get index cost, my capital outlay at 12.5% is 500 rupees. Now, this is where the real issue comes up, right? So I think if you ask me one wish list, the wish list is that at least index cost concept should be brought back for residential units for individuals and HUFs. It's actually required because this is a country where people actually have real estate as a liquidity event, and that's a large population.
Okay. I'm going to leave it there, Hemal. I think you've explained the concerns. And when I look at those charts, those clearly is why the problem of taxation without indexation exists. And the government may well have to take a relook, particularly, as Hemal says, in the case of property sales involving residential properties. That really is the concern at the moment. Hemal Mehta, for joining me on the show and explaining them with your charts, I really appreciate you making that effort. Thank you so much for joining me.
Thank you.